It was just after midnight on a Wednesday when the screen changed. An investor sat in the blue glow of a laptop, refreshing an account that was supposed to be boring. This was the Sleep at Night Dividend Mutual Fund, the one that financial brochures promised would quietly send cash every quarter, no drama, no fear. Then the new number appeared. The monthly dividend estimate had been cut almost in half. For a moment, nothing moved. The cursor blinked. The balance was still there. The fund's name still carried words like conservative and equity income. But the projected payout, the money earmarked for rent, groceries, and medication, had been slashed during a single wave of market panic. The scary part is, this was not a speculative product. This was the fund that retirees had been told to trust for decades. It owned blue-chip stocks, had a long track record, and for a while, its yield line on the chart looked calm and predictable. On the surface, it was the financial equivalent of a sturdy brick house. Underneath, it was already cracking. In the distribution history, there had been tiny cuts during every major crisis. A few cents less here, a quiet reduction there. Never big enough to trigger headlines, never dramatic enough to be called a failure. But the pattern was there, a staircase gently leading downward every time the economy shook. Here's where things get uncomfortable. The danger was actually visible in the numbers that were supposed to be comforting. The headline yield hovered far above safer benchmarks. The sector breakdown showed an unhealthy concentration in banks, energy, and real estate investment trusts, all sectors that bleed when credit tightens and asset prices fall together. The payout ratio told an even more disturbing story. The fund was distributing almost everything it collected, with little margin for error. In other words, any serious earnings decline in those companies would have only one result: the income stream would have to be cut fast. That late-night refresh simply exposed what had been building for years. The incredible part was how many investors had no idea. They saw a stable chart and a glossy fact sheet. They heard phrases like defensive, value, and income focus and assumed that meant resilient. But some dividend mutual funds are engineered like shock absorbers, built to keep paying through recessions and market crashes. Others are built like pressure tanks, holding in risk until one violent move forces everything to release at once. What would have happened if that cut had come after a job loss or during a medical emergency when outside income was already under stress? For many households, this is not a hypothetical question. This episode will dissect which dividend mutual fund structures have actually held the line through past crises and which ones quietly cracked. It will expose the red flags hidden in yield, sector concentration, expenses, and payout policies that almost no one reads before buying. And by the end, the calm surface of safe income may look very different. That calm surface has a name. It is the Dividend Dark Zone. On the outside, dividend mutual funds are marketed as the opposite of drama. The language is soothing: income, stability, conservative, sleep at night. The brochures show couples on beaches, retirees on porches, children on bicycles. Nothing looks dangerous. But the thing is, behind those images sit dense portfolios of banks, utilities, pipelines, foreign conglomerates, and complex derivatives that can change behavior in a single panicked week. In other words, the branding is quiet, the machinery is not. Fund companies learned long ago that the word income disarms people. The phrase passive income goes even further. It suggests a stream that never runs dry, a check that arrives whether markets crash or not. Here is where things get uncomfortable. Many dividend mutual funds have, at times, kept that illusion alive by handing investors their own capital back and calling it a distribution. On a statement, it all looks the same: a line item labeled dividend, a percentage called yield. For a while, no one notices that the share price is slipping faster than the income is arriving. The scary part is that this erosion is often invisible until a crisis hits, and the result was, in past crashes, investors watching both their payouts and their principal collapse together. This investigation is not a list of hot picks, it is a forensic breakdown. The focus is on structures, metrics, and behaviors across full market cycles, not on what is trending this quarter. What would have happened to a high-income fund in 2000, in 2008, in 2020 if its payouts were mostly financials or energy? Which funds quietly kept paying through every major shock, and which were one bad quarter away from disaster? The incredible part was how often the clues were visible years in advance. expense ratios that bled returns, turnover so high it suggested frantic trading rather than patient ownership, sector concentration that looked safe in calm years but became pretty disturbing when a single industry rolled over, high headline yields that, under the surface, depended on leverage or return of capital. This episode will move methodically through the dark zone. First, it will decode what a dividend mutual fund actually is, how cash flows from companies to funds, then to investors, and how accounting choices can make fragile income look solid. Then it will move through the main species of these funds: dividend growth, high yield, equity income, international income, and balanced income that mixes stocks with bonds. Along the way, specific metrics will act as warning sirens. Yield, payout ratio, distribution history, expense ratios, turnover, sector maps, and dividend stability in past crises will be dissected like evidence at a crash site. Eventually, these pieces will be used to assemble sample portfolios designed to do one thing: survive the next crash with their income stream intact. By the end, the Dividend Dark Zone will not be mysterious anymore. Viewers will be able to distinguish funds that endured every major drawdown of the last 30 years from those that only looked safe in the sunlight. And the next section will begin by opening up the first layer: what a dividend mutual fund really is when the marketing is stripped away. When a fund looks safe on paper but behaves like a trap in real life, the damage is rarely obvious at first. It only becomes clear when someone is standing right on the edge of retirement and discovers that the sleep at night income they thought they bought was anything but. Consider a near retiree in late 2007. After decades in broad growth funds, watching markets climb, they decided it was finally time to de-risk. They sold those growth holdings and shifted almost everything into a high-yield dividend mutual fund that promised a generous payout and a focus on stable income. The marketing made it sound like moving from a stormy ocean into a protected harbor. The scary part is that the harbor was already flooding. Within months, the downturn hit. Prices slid first, then the headlines changed tone. For a while, the monthly statements showed a painful but still temporary loss. In other words, as long as the dividends kept coming, the plan could limp through the storm and eventually recover on the other side. Here is where things get uncomfortable. The fund's payout was built on fragile sectors and stretched balance sheets. As credit markets froze, several big holdings slashed or suspended their dividends. The fund had no choice. Its own distribution was cut sharply, right when its investors were about to start drawing checks to replace a paycheck. The result was brutal. To fill the income gap, those investors were forced to sell shares in a falling market. A paper loss, which could have healed over the next decade, was converted into a permanent wound in their retirement plan. What would have happened if the dividends had merely held steady for 2 more years is disturbing to think about, because the difference compounds for the rest of a lifetime. The incredible part was that not every dividend mutual fund behaved this way in the same crash. Some lost far less income and capital. Their mandates forced them away from the most toxic yields. Their portfolios were built around dividend growth, balance sheet strength, and sector diversification instead of chasing the highest headline number. Scientists of portfolio construction had warned for years that concentration and leverage were silent accelerants. In 2008, that theory became very real. This is where the idea of sleep at night income enters the picture. It is not the fund with the loudest yield on the fact sheet. It is the income stream most likely to keep flowing when markets are burning, when boards everywhere are looking for expenses to cut, and when investors can least afford to sell. And the scary part is that in multiple recent crises, entire categories of popular dividend funds came within months of slashing payouts together. They had no idea how close they were to a synchronized income shock. In the next section, the real question becomes unavoidable. When a dividend mutual fund is opened up and stripped to the frame, what exactly is inside that makes the difference between survival and collapse? When the casing is stripped away, a dividend mutual fund is not a mysterious machine at all. It is a very specific kind of container, and the scary part is how many investors never really see what that container actually holds. At the most basic level, a mutual fund is a pooled basket of investments. Thousands of investors put money into the same pot. A professional management team then uses that pot to buy a whole collection of stocks, bonds, or both. In other words, each investor does not just own one company. Each share of the fund is a tiny slice of every underlying holding inside the basket. A dividend mutual fund narrows that basket. Instead of owning any stock, it targets companies that send out regular cash distributions. Those are dividends. The fund collects this stream of cash from dozens or even hundreds of businesses, then passes much of that cash through to its own shareholders as fund dividends. The result was a structure that can feel like a steady paycheck, even though the money is flowing through several layers. Here's where things get uncomfortable. Owning a single dividend stock means that income lives or dies with one company's board of directors. One decision in one meeting can halt payments overnight. With a dividend mutual fund, the dependence shifts. Income now rests on hundreds of boards, filtered through the rules the fund follows. On the surface, that sounds safer. For a while, it usually is. But the thing is, those rules are not vague. They are written down in a formal document called the mandate or prospectus. It is the fund's rule book. It spells out what kinds of dividend-paying companies the fund is allowed to own, how concentrated it can become in one sector, how much risk it may take, and how aggressively it can chase yield. The incredible part was how often this quiet document explained what would have happened in past crises. A mandate that prioritizes maximum yield at any cost will often drive a fund into fragile corners of the market, deeply indebted companies, troubled sectors, or businesses already under pressure. When stress hits, those dividends are the first to be cut, and the fund's payout can collapse with them. That is pretty disturbing when the fund is sold as safe income. By contrast, a mandate built around dividend growth or stability forces the managers to favor companies that have survived recessions, maintained payouts, and even raised them through downturns. Scientists of finance have tracked these patterns for decades. Funds with conservative mandates often look boring in good times, but they keep paying when aggressive funds are slashing distributions. Understanding that mandate becomes the first real line of defense against being blindsided. It reveals whether the fund is quietly engineered for yield, for growth, or for stability. The next question is obvious. Once the rule book is known, which specific clues in the numbers show whether a fund is a survivor or a future casualty? The next clue looks comforting at first glance. It is a single number that seems to promise exactly how much cash will quietly arrive every year. Dividend yield. In other words, the annual cash a fund pays out divided by the price paid for one share, expressed as a percentage. If a fund distributes $2 over a year and its share price is 80, that is a 2.5% yield. It feels clean, objective, almost like a fixed interest rate. Now imagine two funds sitting side by side on a screen. One is a broad, diversified dividend growth fund anchored in companies that have raised payouts for decades. Its yield shows 2.5%. Next to it is a concentrated high-yield fund loaded with riskier names in troubled sectors. Its yield flashes 8%. Which one looks safer to someone searching for income after a long day at work? Which one feels like the answer to rising bills and a shrinking paycheck? Here's where things get uncomfortable. That 8% headline can explode higher not because the fund is paying more, but because its price is quietly collapsing underneath. When a portfolio heavy in distressed energy, over-leveraged real estate, or shaky business development companies sells off, the math twists. The same dollar of distributions divided by a much lower price suddenly becomes a very high yield. The scary part is that the moment the risk is spiking, the yield number looks the most generous. For a while, this can look incredible on paper. Screens rank it near the top. Income-hungry investors pile in, thinking they have discovered a hidden income machine. They have no idea that the yield is being propped up by sectors that are bleeding, companies paying out more than they earn, or managers quietly classifying part of the check as return of capital. The result was always going to be the same. Eventually, something snaps. This is the essence of a yield trap. A fund whose high yield is driven not by healthy, growing earnings, but by distress, unsustainable payout ratios, or the slow erosion of the investor's own capital. It looks stable. It feels like a lifeline. But underneath, the portfolio is being hollowed out to keep that percentage number from falling. It is pretty disturbing how long this can continue before anyone notices. What would have happened if the next recession hit while someone was depending on that 8% to cover rent or medical bills? One bad quarter, a wave of dividend cuts in the underlying holdings, and the fund's own distribution is suddenly slashed. The yield number drops only after the damage is done. The incredible part was how many of the worst offenders were once marketed as income